Episode 13. Failed Auctions When the Market Lies. If you trade long enough, you eventually realize something uncomfortable. The market lies. It breaks levels it shouldn't. It accepts price where it shouldn't. It invites participation, then punishes it. This episode is about recognizing when an auction fails, and more importantly, how Harmonia lets you see that failure early before it turns into damage. Because failure isn't random. It's structural. Let's clear something up first. A failed auction is not "price went against me." That's not failure. That's noise. A failed auction is when the market attempts a process, invites traders to participate, and then refuses to complete it. In Harmonia terms, failure looks like this. Price accepts, but doesn't go anywhere. Distribution starts, then stalls. Extremes advertise, then reject violently. Balance returns faster than it should. Failure is the gap between expectation and outcome. The most common failure, and the one that hurts the most traders, is false acceptance. Here's what it looks like. Price closes above the 20% zone. Traders get excited. Bias locks in. Everyone assumes continuation is coming. But then, follow-through never shows up. Price hesitates. Momentum dies. And price rotates right back toward equilibrium. That's not continuation. That's the market testing participation and finding none. This is where Harmonia matters. Because Harmonia doesn't just care about touching levels, it cares about behavior over time. False acceptance usually shows itself clearly. Progress beyond 20% is shallow. Price struggles to move toward 50%. Rotation starts showing up immediately. When acceptance forms but momentum disappears, that's not a green light. That's a warning. Another common failure happens mid-auction. Price accepts above 20%. Distribution begins. Price pushes higher, then stalls near 50%. And instead of continuing, it rolls over. That tells you something important. The market tried to distribute and couldn't. A 50% rejection is not neutral. It's information. Often, it leads to a full rotation back to EQ or even a complete reversal through it. Now let's talk about the one traders love the most. Turtle soup. Here's the truth. Turtle soup is not a pattern. It's a failed auction at the extreme. The sequence is always the same. Price pushes into the 80 to 100% zone. Highs or lows break. Breakout traders pile in. Continuation should happen, but it doesn't. Price snaps back into structure. That's not magic. That's exhaustion combined with zero sponsorship. Harmonia exposes this clearly because extremes are defined statistically, not emotionally. Turtle soup is just the market exposing a lie. Here's why failed auctions move fast. When an auction fails, trapped traders rush to exit. Participants panic. Liquidity flips direction. That's why failures often lead to fast runs back to equilibrium. Violent reversals. Clean fades with urgency. This isn't randomness, it's correction. Here's the rule that saves accounts. If the market cannot do what it should do, stop believing it will. Harmonia defines should. If acceptance occurs, price should move toward 50. If distribution starts, price should not immediately return to EQ. When should breaks, your bias has to break with it. Immediately. One important warning. Not every failed auction is a trade. Sometimes failure just means don't press. Don't force. Let balance return. Harmonia isn't about trading more. It's about knowing when not to. Failure is not a flaw in the market. It's a feature. Professionals expect failure. Retail traders fight it. Failure teaches you where liquidity isn't, who is trapped, where the next real move may come from. Harmonia doesn't hide failure. It highlights it. And that's an edge. Now you understand how auctions fail, how traps form, why expectations break. There's one more layer that determines whether the same setup works or fails. Timing. In the next episode, we're going to talk about when setups work Session behavior. Time of day effects. Yikes. Why the same level behaves differently in Asia, London, and New York? Same market, same structure, very different outcomes. That's episode 14.